Imagine an ETF that pays you every single week, sometimes handing out more in a month than many stocks deliver in a year, all tied to one of the most volatile names in the market, Coinbase Global. The ticker is CONY, the Yield Max Coin Option Income Strategy, ETF. On paper, it flashes a 191% headline yield. In reality, its net asset value has already fallen 90% from the launch reference price. That combination of eye-watering cash and punishing capital decay is exactly why we are dissecting it today. This is not a set-it-and-forget-it income machine. It is a precision options engine that converts Coinbase's price swings into weekly premium, and we are going to watch every gear turn. Yield Max launched CONY on August 14, 2023. It is a derivative income fund that seeks current income plus capped gains on Coinbase stock through a synthetic covered call approach. The fund is collateralized almost entirely by cash and short-term U.S. Treasuries rather than holding Coinbase shares outright. That structure lets it generate large weekly distributions while keeping the underlying exposure synthetic. As of July 10, 2026, the ETF manages $361 million in assets and carries a 1.04% expense ratio. Payments arrive every week. The strategy is deliberately narrow: one stock, one options overlay, one aggressive income target. Understanding how that narrow mandate actually works is the only way to judge whether the payouts are sustainable or simply eating the fund from the inside. This video is for educational and research purposes only. It is not financial, investment, tax, or legal advice. It is not a recommendation to buy, sell, or hold any security. Exchange-traded funds can and do lose value. Past distribution rates and performance do not predict future results. Always read the current prospectus, statement of additional information, and most recent shareholder reports before making any decision, and consult a qualified professional who understands your personal situation. Right now, CONY trades at a net asset value of $19.63. That price already tells part of the story. The fund sits on $361 million in assets. It pays weekly, which is aggressive even inside the income ETF world. The expense ratio of 1.04% comes straight off the top before any distribution is calculated. Those basics matter because every basis point of cost and every week of payout compounds the pressure on a fund whose NAV has already traveled a brutal path. The snapshot is simple: high cost, high frequency, single name exposure, and a market price that has collapsed from its starting level. Everything else we discuss flows from that foundation. The headline distribution yield sits at 191%. That figure comes from annualizing the most recent distribution against the current net asset value. The latest payment was 28 cents per share. A separate mechanical annualized rate using the latest 4 payments comes in at 74%. The gap between those two numbers appears because headline yield can be inflated when the share price has already fallen sharply. Early in the fund's life, the first 4 distributions averaged $18.60 each. The most recent 4 averaged 27 cents. That compression happened while the NAV itself was dropping, so the percentage yield stayed sky-high even as the actual dollar amounts investors received shrank dramatically. High yields on single stock options funds often reflect both rich premium collection and the mathematical effect of a depressed price. The question is which part dominates going forward. Distribution amounts have followed a clear downward trajectory since launch. The early payments were enormous in absolute terms because the fund started with a much higher net asset value, and because implied volatility on Coinbase was elevated right after the 2023 crypto recovery. As the share price eroded, and perhaps as the options market priced in more moderate moves, the dollar size of each weekly check fell. The first 4 average of $18.60 versus the latest 4 average of 27 cents is not a rounding error. It is a structural signal that the income engine is producing less cash per share than it did in the opening quarters. Weekly payers in this category can maintain high percentages only as long as either volatility stays rich or the fund keeps returning capital. The trend line suggests the fund has already moved from the first regime toward greater reliance on the second. The launch reference price was $197.58. The current net asset value is $19.63. That is a 90% decline in NAV since inception. The maximum drawdown reached 94%. Net asset value is the per-share value of the fund's actual holdings after liabilities. When it falls this far this fast, it usually means the synthetic long position in Coinbase lost far more than the collected premiums could replace. Short-term treasury bills provide a steady but modest yield, yet they cannot offset large directional losses in the options overlay. The NAV path therefore shows the cost of the income strategy in real time. Every week the fund pays out more than it earns in some periods. The difference comes from selling assets or writing new options that further cap future recovery. That same NAV number is what determines how large the next distribution looks on a percentage basis. The lower it goes, the higher the quoted yield climbs, even if the dollar payout stays flat or shrinks. If you simply add up every cash distribution paid since launch, you get $336.40 per share. Layer that on top of the current $19.63 NAV, and the simple distribution-inclusive return since inception reaches 80%. That figure stands in stark contrast to the 90% NAV drop. The difference is almost entirely the distributions themselves. In other words, the fund has returned most of its original capital to shareholders through weekly checks, while the remaining stake has shriveled. This is the classic profile of an aggressive options income vehicle: strong cumulative cash flow paired with severe principal erosion. Investors who reinvested every distribution would have a different outcome than those who spent the income, yet even the reinvestment path cannot escape the fact that the underlying options engine has not preserved capital. The 80% total return number therefore functions as a warning label as much as a performance statistic. Here is exactly how the machine works. CONY does not buy Coinbase shares. It holds United States Treasury bills at 92.36% of assets, United States dollars at 8.14%, First American government obligations fund at 3.14%, and a small cash offset. Against that collateral, the fund maintains a synthetic long position in Coinbase through options and simultaneously writes call options on the same name to collect premium. That is the synthetic covered call structure. Each week the fund sells short-dated calls, receives the premium upfront, and uses a combination of that premium, treasury interest, and sometimes return of capital to fund the distribution. The trade-off is built in. If Coinbase rises sharply above the strike price of the calls the fund wrote, the upside is capped. The synthetic long is effectively called away at the strike. If Coinbase drops, the synthetic long loses value, and the collected premium provides only a partial cushion. Because the fund targets a high weekly payout, any shortfall between premium income and the target distribution is filled by returning capital, which directly reduces the net asset value and sets up the next round of percentage yield math. The two call options referenced in the holdings are the active short positions generating that premium. Rolling them weekly keeps the income stream alive, but also keeps the upside ceiling in place. In plain terms, the strategy sells insurance against large Coinbase moves and pays the collected premium out to shareholders immediately. The insurance can be profitable for long stretches, yet a single sustained rally or a prolonged decline can still destroy the underlying capital base faster than new premiums can rebuild it. Going forward, watch three variables that can shift the picture quickly. First, Coinbase implied volatility. Rich volatility inflates call premiums and supports higher distributions. A compression in volatility tightens the income engine even if the share price stays flat. Second, short-term treasury yields. The 92% allocation to T-bills contributes real income. Any sustained drop in rates reduces that contribution and increases the chance that distributions rely more heavily on return of capital. Third, the actual strikes and expirations the fund selects each week. If the manager consistently writes calls with very little room above the current price, the cap on upside becomes tighter and NAV recovery becomes harder even in a favorable Coinbase environment. Also track assets under management for signs of meaningful outflows, because shrinking scale can raise the expense ratio's effective bite and force less favorable options execution. None of these items require daily monitoring, but a material change in any one of them usually shows up in the next few distribution amounts or in the next NAV report. Those are the forward signals worth tracking rather than the headline yield number alone. CONY is a high-octane weekly income engine built on Coinbase volatility and Treasury collateral. It has already delivered enormous cash distributions while destroying most of its starting net asset value. The strategy works exactly as designed when volatility stays elevated, and the fund can harvest premium faster than it loses on the synthetic long. The same design produces steep drawdowns and heavy reliance on return of capital when the underlying moves hard in either direction. For an investor who wants maximum current cash flow, accepts the capped upside, and treats the principal as secondary, the fund can serve that narrow purpose. For anyone seeking durable income without watching the share count erode over time, the 90% NAV decline and the shrinking dollar payouts tell a different story. The numbers are not broken. They are the predictable result of turning one of the market's most volatile stocks into a weekly premium factory. Understanding that trade-off is the entire point of opening the hood. 2 quick things before you go. If this teardown helped you see past the headline yield, hit the like button. It genuinely helps the channel. Subscribe so the next ETF autopsy lands in your feed. And drop a comment. Which ticker should we put on the table next? And where do you think the real risk is hiding? We read everyone. Thanks for watching.